Welcome to Learn, Invest, Grow, the podcast dedicated to simplifying the world of finance so you can build a better tomorrow. I'm your host, Alec. In our inaugural episode, we're starting at the very beginning, tackling the single most common question I get. I've managed to save my first $1,000. Where do I even begin with investing? Before we go any further, I want you to take a moment and acknowledge that achievement. Saving that first $1,000 is a huge milestone. It represents discipline, sacrifice, and the first concrete step towards taking control of your financial life. So, congratulations. Today, we're going to make sure that hard work starts working for you. Now, the biggest hurdle for most people isn't the money, it's the mindset. We're taught to be consumers, and if we're diligent, we become savers. But an investor thinks differently. A saver sees a dollar and thinks about how to protect it. An investor sees a dollar and thinks about how to turn it into more. Investing isn't about gambling or risky bets. It's about ownership. When you invest, you are buying a tiny piece of a real business or hundreds of them that are creating value, generating profits, and growing over time. The goal with this first $1,000 isn't to get rich quick. It is to shift your mindset from simply saving money to making your money grow. It's about planting a tree that, over many years, can grow into a forest. This requires patience and a long-term perspective. So, let's get practical. Step 1. You need a place to buy and hold your investments. This is called a brokerage account. Think of it like a special bank account designed specifically for stocks, bonds, and funds. Opening one is usually a simple online process that takes about 15 minutes with any major financial institution. But here, you have a critical choice to make about the type of account. Your two main options are a standard taxable brokerage account or a tax-advantaged retirement account, like a Roth IRA. A standard account is flexible. You can put in as much money as you want and take it out anytime. However, when you sell an investment for a profit, you'll owe capital gains taxes on that growth. A Roth IRA, on the other hand, is a game changer for long-term goals. You contribute money you've already paid taxes on, but then your investments grow completely, 100% tax-free. When you pull the money out in retirement, you owe nothing to the government on all those decades of growth. There are limits on how much you can contribute each year, but for a beginner, a Roth IRA is often the most powerful starting point for building long-term wealth. All right, step 2. Your account is open and your $1,000 is ready. Now, what do you actually buy? This is where people get paralyzed. They imagine having to pick the next Amazon or Tesla, and the fear of choosing the wrong stock stops them from doing anything at all. I want you to forget about picking individual stocks for now. There's a much simpler, safer, and more effective way to start. We're going to talk about my favorite tool for new investors, the low-cost broad market index fund. That might sound complex, but the idea is beautiful in its simplicity. Instead of trying to find one needle in a haystack, you buy the entire haystack. An index fund holds stocks in hundreds or even thousands of companies, all bundled into a single investment. For example, an S&P 500 index fund gives you a small piece of the 500 largest companies in the United States. With one click, you own a sliver of Apple, Microsoft, Johnson & Johnson, and hundreds more. This gives you instant diversification, which drastically reduces your risk. And because these funds are passively managed, their fees, called expense ratios, are incredibly low, meaning more of your money stays invested and working for you. You can typically buy these as either a mutual fund or an ETF, an exchange-traded fund. For now, just know they are the simplest path to owning a diversified piece of the market. Now, if even that sounds like too much work, there is an even more hands-off option, the Robo-Advisor. These are automated online platforms that do all the work for you. You sign up, answer a series of questions about your financial goals, your age, and your comfort with risk. Then, their algorithm builds and manages a globally diversified portfolio for you. They automatically rebalance it and adjust it over time. It is a fantastic set-it-and-forget-it solution, but it comes at a small cost. They typically charge a small annual management fee, usually around 0.25% of your assets, on top of the underlying fund fees. For many, this small fee is well worth the peace of mind and convenience. Before we move on to building the habit, I want to expand on that word I mentioned earlier, diversification. It's one of the most important concepts in investing. While an S&P 500 index fund is a fantastic start, true diversification means not putting all your eggs in one basket, and that includes not putting them all in one country's basket. The US stock market is the largest in the world, but it doesn't represent the entire global economy. Companies in Europe, Asia, and other emerging markets offer incredible growth opportunities. Spreading your investments globally can cushion your portfolio when one particular market is struggling. Furthermore, diversification isn't just about different stocks, it's also about different types of assets. The other major category you should know about is bonds. Think of bonds as a loan you make to a government or a corporation. In return, they pay you interest over a set period and then return your principal at the end. Bonds are generally considered safer and less volatile than stocks. They don't typically offer the same high returns, but they provide stability and income to your portfolio. When stocks are down, bonds often hold their value or even go up, acting as a crucial shock absorber. This mix of different investments, U.S. stocks, international stocks, bonds, and maybe others, is called your asset allocation. As a young investor with a long-time horizon, your allocation might be heavily weighted towards stocks, say 80 or 90% to maximize growth. As you get closer to retirement, you might shift more towards bonds to preserve your capital. You don't need to get this perfect on day one, but understanding that a truly diversified portfolio includes more than just one type of stock is a key lesson for the road ahead. This brings us to our final and most critical point. Step 3 is about building the habit. That $1,000 is your launch pad, not your final destination. The true magic of wealth building comes from consistency. This means setting up automatic contributions. Even if it's just $50 or $100 a month, automate it. Have it transferred from your bank account to your investment account every single payday. This strategy is called dollar cost averaging. When you invest consistently, you sometimes buy when the market is high, and sometimes you buy when it's low. Over time, this averages out your purchase price and removes the temptation to try and time the market, which is a fool's errand. When the market inevitably dips, savers panic. Investors see it as a sale and continue buying, knowing that historically the market always recovers and goes on to new heights. So let's recap. First, shift your mindset from saver to owner. Second, open an investment account. A Roth IRA is a powerful place to start. Third, buy a simple, diversified, low-cost investment like an S&P 500 index fund. And fourth, automate your future contributions to build the habit. Don't get lost in the noise. Just start. That is the most important step. That's it for our first episode. Next week, we'll do a deep dive into the eighth wonder of the world, compound interest, and why starting now is the single greatest advantage you have. Thank you for joining me on Learn, Invest, Grow.